Okay, I am doing the market outlook this week from outside. All the rooms here are full, so I've lost my office. You may hear the birds in the background. I have asked them to keep it down, but birds, they can be assholes. Let's start with the jobs number, and it wasn't good. We had revisions as well. Let's have a look at June. We had 14,000. That was from the last revision. We have another revision. It is now negative 13,000. You can see it on the chart over here. Little thing peaking negative. July 73 increased to 79. Not enough to really offset what happened this month. We jump right to the establishment down here at 22,000. Private was 38. Government negative 16. Now, I don't know that we should be too disappointed in negative numbers down here, because a negative here is a positive somewhere else. If you take the average government salary all in and you multiply by the 16, you get to about $1 billion. So that is $1 billion that the government does not have to raise through debt issuance to pay for that, because, well, they're already running a deficit. So if they kept that billion, the deficit would be $1 billion bigger. That's taxpayer money for that billion. Saving $1 billion is the same as raising revenue $1 billion, except the only people paying the tax are these people who lost their job. So instead of getting a paycheck, since it's all taxed, they get nothing. You can think of it that way, that only those people are paying the tax, that extra $1 billion. In private goods, lost 25,000, services up 63, but healthcare was 46,000 of that. So if the private sector created 38 and you take out healthcare, you actually lost jobs that are non-healthcare related. I make that distinction, and we have to think about it in two ways. You can think about it in terms of aggregate demand, and you can think about it in terms of the productivity of the economy. In terms of aggregate demand, doesn't matter what somebody does. If they receive a paycheck, you create demand because that person will then go out and spend that money. However, healthcare is not a productive activity for the economy. I've made this case before. You can think of healthcare as maintenance capex. That if you have an asset, every year you got to spend some money just to keep that asset in the same productive capacity it was the year before. So you're spending money on it, but you're not increasing its capacity. You're just maintaining its capacity. You can think of healthcare in the economy as really maintenance capex. It doesn't make the worker more productive. It just maintains the productivity the worker had. So it is not a GDP growth engine, although it does add to aggregate demand, probably in the same measure that they are paid, so no multiplier on that. You may hear planes landing as well. This is just the occupational hazard of working outside. Manufacturing and construction. I'm going to pick on these two right here because we hear the administration talking about trillions of dollars pouring into the economy. Construction on facilities is underway. This is going to be massive. You're going to see these big job numbers in about a year when all this construction is done. Manufacturing lost 12,000 jobs. If we go back to July, it lost 2,000 jobs. If you go back to June, it lost 17,000 jobs. That does not sound like we're bringing manufacturing jobs back to the U.S. It sounds like we are losing manufacturing jobs. But maybe there's a lot of construction going on. Maybe all of these things are being built, and we're creating massive jobs in the construction sector until these facilities are open. So let's look at construction. Lost 7,000. July lost 1,000. June lost 2,000. This does not sound like a sector that is building a lot of factories and plants right now. Otherwise, those numbers would be bigger. So manufacturing and construction are not telling the same story the administration is telling. So we must conclude one of two things. The administration is just making stuff up, and maybe they believe it So we won't say they're lying, or maybe they know it's not going on and they're just lying, or the numbers are rigged. I know which side the administration falls on, but what side do you fall on? The household survey is telling a different story. We have a labor force that has increased 436,000, participation rate ticked up 0.1, and employed 288,000 versus only 22,000 since we really just look at the establishment survey. It's the bigger survey. It has the tighter standard error. 288,000 statistically based on the sample size, and the standard error is really no different than zero at a 95% level of confidence. 22,000 is really no different than zero at a 95% level of confidence, and this has been going on for a while, for a number of months this year, where if you look at the job number and you look at the standard error, it falls zero, falls within the 95% confidence interval. And many of you have been through level 1 quant. I know some of you are starting to break out in a little bit of a cold sweat right now, just me saying that. But you do remember your 95% confident intervals. If they contain zero, you cannot with confidence say the number you have is any different than zero. Average weekly hours unchanged. Average hourly earnings up 0.275. That is consistent with an annual increase of 3.34%, which the Fed says is consistent. 3.5 to 4.5 wage increase is consistent with a 2% PCE. Nothing to see here in terms of wage inflation. This is perfectly normal. Now, I'm going to make a pretty wild prediction that over the next couple of years, you're going to see average hourly earnings go way up. Way up. And that is going to be an AI effect, because experts are going to be bid up. AI will replace non-expert workers. AI will replace probably in some fields 20-30% of the employees. AI will eliminate jobs that otherwise would have been created. You're hearing it and seeing it now. We're getting almost no job creation, but we're not getting massive layoffs. That is consistent with companies saying, things are uncertain, let's hold off. Or look at this AI thing, look what it can do. Let's lean into that. Let's find more ways to use this. The layoffs haven't come yet, but I do believe they will be coming. Those will be low-skilled, cognitively low-skilled jobs, but experts. You can't replace an expert with AI, because AI does not have metacognitive ability, nor do I think it can get metacognitive ability, and that's where the experts live. So it makes an expert far more productive, and most organizations will tell you that about 20% of their staff is responsible for most of the output that they do, that if they could have more of those people, they would. Well, now they can. They can have more of that individual with AI. Increase their output, I know for me, a factor of 5. Think about that. So even if you can increase it by a factor of 2, you've increased the weighting on your experts from 0.2 of your organization to 0.4. You can get rid of the bottom 20%, but the experts, because there's so few of them, will be bid up over time. The big gains, the biggest winners, I think, from AI will be experts. So look for the average earnings to go up. Average weekly earnings unchanged because you have hours unchanged. So it's basically just going to be, so I shouldn't say unchanged. It's the same as this because your average weekly hours are unchanged. Diffusion index, both of them, the total level and manufacturing level. This is a measure of job creation. Both of them below zero. The diffusion index means over 50 is expansion, under 50 is contraction. They are both under 50. We look at the average duration of unemployment. May, June, July, August. In May, it was 21.8 weeks was the average duration. June jumped to 23 weeks. July jumped to 24.1 weeks. August 24.5 weeks. Those who are unemployed are staying unemployed longer. Another sort of fingerprint of the no hiring, no firing, but no hiring phase that we seem to be in right now. From the household survey, full-time down 357,000, part-time up 597,000. Keep in mind we're trying to recover that 288. Statistically, these numbers don't always add up. High school, negative 463. Less than high school. If you got high school, look at that, 675. Less than BA, minus 83. BA plus 450. So those who don't complete what they started, we don't want you. But those who have at least completed what they started, will take you. All in all, this is consistent with what we've seen over the last few months, consistent with what Governor Waller has been pointing out. And an interesting thing, after this jobs report, if you are looking at Fed funds futures or the FedWatch Tool, the probabilities on zero rate cuts have completely disappeared, and we now have some probability on a 50 basis point cut, and the Fed funds futures is now firmly pricing in 3 cuts this year. Let's have a look at rates and yields. Big drop right across the board. Thank you, jobs report, for that. So as of now, all rates except the 30-year flat versus the beginning of the year, all rates now are lower than they were at the beginning of the year. Look at the 10-year, 50 basis points lower than it was at the beginning of the year. The 2-year down 75 basis points. Money market not really changing very much. It is beginning to price in a significant move in September, that being at least 25, maybe even 50. We can see the probabilities over here. Sorry about that airplane in the background, but it is taking quite a long time to land. 89% for a 25 basis point cut. It was 86.4 last week, with the other 13.6 being on zero. But now we have 11% sitting at 50 basis points, where it was zero before. If we think about the jobs market over the last 4 months and the potential it has on aggregate demand, and aggregate demand feeds into GDP, a cut is all but certain for September. Powell signaled as much. Why they wouldn't go 50, to me, being that I think they should have already gone 25, you might get 50, and we get the dot plot at the same time. We get the summary of economic projections. I am betting Stephen Mirren is going to show up at the very bottom of that distribution. Curve is upward sloping, just slightly upward sloping. My forecast for the curve over the next year is a significant steepener on the money market to capital market curve. How do you play that steepener? You don't. The 3-month has no duration, so you cannot set up what is called a duration neutral curve steepener. You can do it from the 2 to the 10, but I don't know if the 2 to the 10 steepens, but the 3-month to the 10-year is definitely going to steepen. So the best sector to be in for a massive curve steepener from money market to capital market are banks, anything in the financials. And I've already made the case for mortgage REITs as well. We do have some significant data this week. Another big test for TLT, and man, did TLT have a nice Friday. 2 days, we get revisions, non-farm payroll annual revisions. 3 days PPI, and I got a 3 in there, should be 4. 4 days we get CPI. So Wednesday morning we'll get PPI, Thursday morning we get CPI. And this is for the month of August, and August began the reciprocal tariff. So PPI, I think, my best guess, PPI will be uglier than CPI. PPI may give me an opportunity to buy more ZQ. I'll tell you what I did with ZQ last week. If you listened to the Q&A video, you know exactly what I did. I might get an opportunity to get in a little bit more. Reverse repo, the lowest, was hit on September 3rd, 17.9 billion, basically a rounding error off of zero. We're sitting at 21 billion reserves, down to 3.16 from earlier in the month when reverse repo was sitting around 80, 90 billion. We were sitting around 3.3 trillion. It's dropping down. I expect that within short order you will have balance sheet runoff set to zero. And you'll still continue, when I say set to zero, I don't mean for the MBS, but for the treasuries and for the size of the balance sheet, which means as MBS rolls off, it will be reinvested into treasuries. And MBS here, of the almost 6.2, I got a B in here. Lots of mistakes here down here today. It's sitting at about 6.2 trillion. MBS makes up 2.1 trillion of that for both residential and commercial. Commercial is only 7 billion. The rest is all agency-backed MBS. So this may be allowed to continue to run off. If you get balance sheet runoff held to zero because, well, ample reserves, you got to guess where that number is. That will incrementally give support to treasuries. My best guess on the balance sheet is by the end of Trump's administration, by 2028, I would say look for this to be greater than 10 trillion. If you want to get that 10-year down to 3%, you can drop the front end of the curve, but if you do it excessively in a way that the market doesn't agree with, if you try to go 300 basis points in the next year, 400 basis points in the next year, the market probably isn't going to come along on the capital market curve unless you have a significant buyer. And when we start talking about gold, we're going to see that we cannot rely on the other central banks in the world to be those significant buyers. They are slowly moving away, which means sort of Japanese style, the central bank will be the major buyer of treasuries. I don't really care as a duration holder how the long end of the curve comes down. I don't care how ugly the goal is as long as it's a goal. TLT up 2.26 week over week. SPX squeaked out a $0.33 index flat, but as of Friday morning it was up there. So it had a chart like this and it was up there Friday and it came right back down. So week over week it appears that it was unaffected by anything, but it was stronger going into payrolls print and then boom, lost it all. Let's have a look at ZQ. Lots of excitement there on Friday. Q3 pricing in 28.5 basis points, which would be consistent with putting some weight on the 50. We're over 25 basis points. Q4 42 for 70 basis points this year. Basically 3 rate cuts, a 50 followed by a 25 or 3 25s. I don't know, but I would not be surprised with a 50. I don't think that is unreasonable to get a 50. The 25 is a sure thing. Going into Q1, 27 basis points, Q2, 25, so it looks like another 2 cuts by the time Powell leaves for a total of 123. That's 5 cuts in 7 meetings. If I jump all the way out to October 2026, because that's the contract I am playing, it's at 97.075. It hit 97, I think it got to 97.11, 97.12, 97.13 that day. It was really moving. And then sort of lost some steam at the end of the day. Implied rate 2.925. That is 140 basis points cuts. You're getting close to 6 rate cuts over 9 meetings. I think once you start getting close to 7 rate cuts over 9 meetings, that's where I would think, okay, that's starting to be a fair game. But right now, I think the game is heavily skewed towards the long position in ZQ. What I did, if you had listened to the Q&A during the week, on Sunday night, I have some people down here for seminars. We were discussing ZQ, and as I was explaining my position, it started to dawn on me that, you know what? I mean, why am I waiting for 92.9? We're at 92.96, and I do believe that we're looking at maybe 200, maybe even more by next October, and we're sitting at 97.96, which is slightly over 5 cuts, and I think we get 8. So why not just buy? So I bought 100 at 96.96. This was Sunday night. Monday the market was closed, but Monday the market did print 96.92. I added another 20, and then it did print 96.90. I added another 20. I now have 152. I really wanted somewhere between 400 and 500 of these contracts because I think I can't lose. If I'm buying with 5 rate cuts, I don't think I can lose. I'm going to get at least 5 cuts by October 2026. Where is my downside? So I bought 100. I don't think I was aggressive enough. So this is why I'm saying I'm hoping. I'm glad that PPI this week is before CPI because I think PPI will be the uglier number. Maybe I get a chance to throw another 200 contracts in there. Love to see a nice big pullback, like 10, 11, 12 basis points. Wouldn't that be nice? Don't think I'm going to get it, but we're pricing in about 6 in 9 meetings. So I think there's another 25 easy points to make here. The next 25 will take a bit more economic deterioration in the economy, a little bit, maybe some more companies warning about earnings going forward, maybe some more negative data, another ugly jobs report, maybe even a negative jobs report. Once we start pricing in 7 to 8 cuts, that's when I'll start to say, okay, let's start to unwind this position. I'm not going to get out, just going to start to unwind it because we do have 3 meetings going into October 26th, 3 meetings ex-Powell, with Trump's chosen person in there. And, you know, getting all the way to May is a long time from now. I'm pretty sure he'll be very close, if not having succeeded in gaining control of the committee, having most of his people in, which will be Trump's Fed, and Trump's not a 25 basis point a meeting guy. 100 points, 200 points. That's why I'm a little hesitant on the longer end of the curve, because if he doesn't make Mr. Market happy with his rate cuts, Mr. Market will make the bond market unhappy with their defiance on the long end. Real yields all down, following nominal yields and inflation expectations, or more commonly referred to as the break-even rate between nominal and real, all down. I have had a question the past week of how do you interpret the break-even rate? If you believe, like let's take the 10-year, 2.37 is an indifference point, a break-even point, saying that if you expect over the next 10 years inflation to average 2.37%, you are indifferent between TIPS versus nominal bonds. TIPS are Treasury inflation-protected securities. You get a real yield, but your principal amount increases at the rate of inflation. So instead of getting $1,000 back in 10 years, if you had 2.37%, you'd get $1,023.70. And then the principal amount would increase at the rate of inflation, such that it protected you. Treasury inflation-protected security. Versus a nominal yield. The nominal yield is at 4.1%. So if you had the nominal bond, its face value is $1,000. You could just take 2.37% and say, well, I'll keep the 2.37%, or sorry, you add the 2.37%, you reinvest that, and you'd have $1,023.70, and then you would have the difference as your return. If it works out that it's 2.37% on average over those 10 years, you're indifferent. If you expect inflation to run below the 2.37%, you may as well lock in the higher rate with the nominal. If you expect it to be higher, you may as well get the real yield, because your capital appreciation will be far greater. That's why it's called a break-even rate. It is the rate at which you would be indifferent between buying those two bonds. And it is called an inflation expectation, because the traders are thinking, well, which one would I buy? And if I think that inflation expectations or the break-even rate is too high or too low, I would then direct my purchase towards tips or nominal. There, that's the lesson for the day. Nothing to see here on yields. High yields are the only ones really moving here. Mortgage 6.5. We have a 10-year at 4.1. I don't know that being below 4 by next week is unreasonable if you have a very benign CPI. We had a hot PPI last month. Does that feed into CPI for this month? If it doesn't, and we have a very benign CPI, maybe by the end of the week, momentum will grow on the 50 basis point cut that the market would accept, and maybe we'll see a 10-year below 4%. This can start heading down towards 6 or under 6%. Maybe we can print a 5 handle at some point before the end of the year. By the way, the 6.5% on the 30-year is the lowest since October 17th, 2024. Basically, almost a 52-week low. Another couple of months here, we'll be at a 52-week low. October 17th. I shouldn't say a couple of months. We're already September 7th. 23, 33, yeah, about another 6 weeks, 5 weeks. We'll have 52-week low. 6.44 was the print then. Now, when I say the lowest, that is on a weekly basis. Corporate issuance. Year to date, we're in August now. Year to date, up 3.6% year over year. And here's our issuance for August. Investment grade, 100 billion. Last August was 107 billion. High yield is 25 billion. Last year was 19. Convertibles almost 10 billion. Last year was 2.45. Nothing to see here. OAS and corporate debt have really been telling us nothing. We're going to look at a couple of stories this week. Here we'll look at Google and Gold. Then we'll hop over to the SPY, look at that. And then we'll spend some time with Lululemon and Broadcom. Yay. Let's start with Google here. This is a 5-year chart for Google. All-time high. Look at that. All-time high. I had the, at the beginning of the week, I had the 190 September puts, the 205 October puts. I did this when Google was sitting about 195. My argument was I think it is easy a multiple of equal with the market, 23, with its forward earnings, put around 225, 230. On Monday, I was going to roll the 190 because it was like 11 cents, close the 190s and roll it past the October and roll it up to about the 230, either for November or December. However, the day got away from me because I do have people down here. I wasn't paying attention to the clock. In my mind, I was thinking 4 o'clock. I kept looking at the clock. Okay, it's 1:45. I got time, lots of time. 2 o'clock, 2:05, around 2:30. Okay, let's go do this. And not realizing or at least I realized, but totally forgetting I'm 2 hours behind. So by the time I went to roll, it was 4:30. It was too late. The damage was done. I didn't get it. So I closed both the 190 and the 205s because they were pennies. I made my gain there, but I am sick with myself for not doing what I was going to do and getting confused with the time. Dumb. No forced divestiture on Android or Chrome. Sony came to the rescue on that one. Ban on exclusive contracts, though. They can still pay Apple, but they cannot have exclusive, the word exclusive in their contracts. They cannot be exclusive. Apple is free to do whatever it wants to do. Apple went up on the news because they're not going to lose that revenue, or the belief is, well, we won't lose that revenue now. Mandatory data sharing, ad syndication requirement. They have to offer this to their competitors on commercial terms. You don't got to give it away. Offer it on commercial terms. That's not always a good thing. Bell Canada has that in Canada. So we have a big country in Canada, coast to coast, and Bell has the largest network. if there is a small startup that wants to start somewhere, the ruling in Canada is that Bell must allow this small startup to use their network. So Bell incurs all this CapEx, builds this all out, and then has to open up their network. That competitive advantage, they must open it up to competitors. On commercial terms, they can charge the competitors a commercial rate, but they must still open it up. It's no longer a moat. So you have that, which is kind of, I think, a bigger deal than the market is thinking. Both Google and Department of Justice expected to appeal this. On Friday, the European Union announced a fine against Google, and Trump immediately responded with, we're just going to hit you with more tariffs. Only America can tax American companies, not fully understanding that a company operating in another country is in that country. For example, GM operates in Canada through a incorporated company, GM Canada, which is a Canadian corporation that the American parent owns. GM consolidates, but it is not just GM incorporated in Delaware that operates everywhere. These are all corporations incorporated within the countries in which they operate. So in essence, the European Union was fining a European Union corporate entity, even if the parent is American. I don't know if Trump understands that. If he doesn't understand it, it's consistent with my thinking of who he is. If he does understand it, what does he care? He's just a bully. This is his tactic. But is he going to come to Google's rescue by calling off his Department of Justice, right? I mean, he does own the DOJ. He can call that off in half a second. So maybe that one goes away. The problem that still lies ahead for Google, and I think it is the bigger problem, is search, is URL searching. When I have questions, I go to Perplexity. When I have a site in mind that I know, I go to Google, because I'm looking for a particular site to go to, a particular website, or I'm looking for a particular restaurant near my home. I will use Google search still for that. But for most things, I'm not going to click on 5, 6, 7 URLs to get the whole story of what I'm looking for. I use Perplexity. Google, I don't see, has that solved. They have AI search, but only in the US. What the hell are you waiting for? Seriously, what the hell are you waiting for? To lose the game? Search is over 50% of their roughly $400 billion in revenue. You got to solve that problem yesterday. I don't see they have a clear solution for that. So I don't know that I'd be chasing this number higher at this point until I see some significant solutions. Now, as far as the AI side goes, I do pay the bigger number in Canadian dollars with taxes in. I'll be somewhere around $380 a month, and I will continue to pay that. I want you to think about that a minute. $4,500 a year I'm paying for a service. Whoever would have thought you'd do that, right? Netflix gets to $25, everybody freaks out. Well, $25 a month is really only $300 a year. This is $4,500 a year. However, if you use this stuff in any kind of business capacity, not just for general household stuff, you'll see that it is absolutely worth it. In fact, even if they charged me $45,000 a year, thinking about the alternative I would have, because it more than doubles my output. I couldn't hire another me, and if I did find someone at the expert level, I'd be $150,000 a year. My output's like 4 or 5x. I'd need 3 or 4 of me. So $4,500 a year to me, that's cheap. That's a steal. You'd pay $4,500 just to get one paper done from an expert, and even that would be low. You'd be paying $10,000. And just if I said, look, I need you to write up something for a sub industry, you'd be $10,000 on just that. So can Google make it with enough of these subscriptions? I think they could offset some of their ad revenue, but they have to show me that they have some kind of transition where they're not going to give up all of that advertising revenue. Gold My God, gold, all-time closing 3,653. Look at that chart over here. You had sort of a tough breakout over here. You had very, very good support right around 33.50. Having trouble at roughly about 35.50. But this week, no. I think this is a 2-year chart. Yeah, 23 to 25 2-year chart we're looking at. All-time high closing. And it did this on Friday with the move in ZQ, the interest rates coming down, belief that, well, gold is really going to perform. Plus, the dollar index really came off as well on Friday. And as the U.S. dollar decreases, the price of gold in U.S. dollars increases. Two big drivers here that don't appear to be stopping. I'm going to say three, really, because we do have to look at the physical geology. Is that a word? Combination, physical geography? The geology of mining gold. The yield per ton has been decreasing for some 30 years. It doesn't look like that's going to turn around unless you have some significant tier 1 findings. And that doesn't appear to be on the horizon either. Which means if you want more gold out of the ground, it's going to cost the mines more to get it out of the ground. So the price would have to go up, otherwise they'll leave it in the ground, thereby constricting the supply of gold. So if we think demand is going to stay constant, just constant, the price of gold must go up because the yield is going down. There's just reason number one. But why would we expect the demand to be constant? Now think about it. If it were constant, the price of gold goes up. But what if demand were going to increase? What's going to happen to the price of gold? Well, we have reserves that are shifting, and we have some negative U.S. dollar sentiment out there. Let's just look at some statistics. You'll recall back in May, I had made a statement about gold hitting a particular milestone. Gold holdings by central banks were greater than their U.S. Treasury holdings. Now, you have to sort of clarify that. That's not saying that gold represents more than their U.S. dollar holdings, just more than their U.S. Treasury holdings. So they could be holding a bunch of T-bills. 43% of central banks are going to increase their gold reserves over the next 12 months. And 76%, I get this from the goldcouncil.org, 76% see gold being a higher percentage of reserves over the next 5 years, a higher percentage. To say that they're going to increase their gold reserves could be, yeah, but if all reserves are increasing your gold reserves, they might just be increasing in proportion. But they're saying, no, a higher percentage of our reserves will be hitting gold. Right now, if we switch over to the U.S. sentiment, 46% of all central bank reserves are in the U.S. dollar in some form. And 73% of central banks see lower U.S. dollars holding going forward. So the USD has got some headwinds here, lower U.S. dollar, higher price of gold just on its own. Reserves are shifting more towards gold, so you are having or are seeing an increase, at least, in expected demand for gold over the next 5 years, and a decrease, at least an expected decrease, for holding U.S. dollars. The combination of that, plus the geology, I can't see how gold just doesn't continue to go up over the next 3, 4, 5, 6 years. Year to date, look at the killer on this. Year to date, up 37%. Little sleepy thing like gold. 1 year return, 44%. But if we account for the change in the dollar, you are only up 37% if you if your domestic currency is the U.S. dollar. If it is not the U.S. dollar, you have to account for the exchange rate. The DXY is just a basket of currencies. It's not in any one particular currency, but it is down 9.85% year to date. So if we take the asset, the change in the price of the asset, along with the change in the price of the dollar, and we combine them, we get hopefully about 23.5% on a basket of currencies, a trade-weighted basket of currencies. Gold is up 23.5% once we adjust for currency change. For each of your own particular countries, you would have to figure out year-to-date how is the U.S. dollar performed against your currency, or better said, how did your currency perform against the U.S., and then adjust the dollar price of gold for your own currency. Okay, let's have a look at SPY before we get to the really ugly story, Lululemon. 649.46 all-time high on Thursday with a big pullback. Big enough on Friday. So we're sitting at 646 on the closing versus almost 650 the night before. Forward earnings, operating earnings, could not find the current week. Went back to S&P, downloaded the spreadsheet, see if they had it updated. They did not. So maybe it had something to do with the 4-day work week last week. It's okay, we'll use last week's 283.34, closing SPX 64.81 gives us 22.875 versus 22.8 the week before. Still just hugging a little under 23 times forward earnings. I don't know that it holds there. You know, there are some measures of the valuation of the market. And I think it was either Barron's or Wall Street Journal had a story about a week ago pointing out how valuations on the market are higher than they were in the dot-com era. So you think, well, given what we're seeing in the jobs numbers, these multiples cannot hold. But we've been here going on 2.5 years now with me saying 23 times, it can't hold. And it does. We get these V-shaped recoveries. Let's see if that continues on. With the Fed next week giving us 25, maybe 50, I mean, I don't see a downside catalyst. This is sort of the economy at stall speed, but it's not contracting, so I don't know that I'd say, listen, the index needs to re-rate to a 19. If it did, that's 4 times 283. Right, you're talking about 1,100 points down. I just don't see the catalyst there. IVP, saying the same thing, sort of fading away. 21st percentile over the last 13 weeks, down from 27. Our big winners here, small caps, IWM. IWM hit 240, the futures and the ETF in pre-market trading. 240. All-time high, 241.98, hit 240, sitting at 237.77, up 1.1% over the course of the week. SPY was up 0.33, so big outperformance there. IJR up 0.923, and Triple Q's up 1%, 0.99, helped significantly by Broadcom. Sector Spider telling us 4 companies are reporting next week, and I'm not even going to pick the dates. Let's just say 4 companies are reporting next week. Their dates are never right. They had some reporting Friday. It just doesn't seem right. But anyways, I put the big ones up here. Oracle. Remember, Oracle had announced last quarter their big deal with OpenAI, $30 billion for cloud services. Can they follow through with something? Can they raise their guidance? Can they pull a Broadcom on this one? You have Kroger and Adobe. If I had to bet, I'd say I'd look for Oracle to do well. I'd look for Adobe to not do so well. And after the market closed on Friday, had some announcements of additions and subtractions. Additions, AppLovin in the communications sector, Robinhood in the financials, and EME in the industrials. What was the name of it? I hadn't heard of it. I had to look it up to see what it was. I have it right here. It is come on. Why am I so unprepared? Enphase. ENPH. Oh no, sorry, that's the one that's leaving. Give me a second. There it is. MCOR. They're in infrastructure, engineering, construction and engineering for infrastructure. Industrials, financials, communications getting a lift. What's leaving? Caesars. in consumer discretionary, and I find this very ironic, almost funny ironic. What do you got coming in? Robinhood. What do you have leaving? Caesars. What do they have in common? Gambling. Just one is gambling with the market, the other is a gambling facility. I find that funny. You have financials coming in and financials going out, and Enphase. It's in IT. I had to look this one up as well. Home solar, and I thought, home solar. But they are in the GICS code classified as semiconductor equipment, which is a head scratcher. I asked Perplexity to tell me more about this company. I'll tell you what I got. To me, it just doesn't seem like it should be classified where it is, but it is. Part of the solar electronics component industry. So I asked, what does it do? Microinverters, energy storage systems, energy management software, EV charging solutions. I asked, what GICS sub-industry is it in? And it is in semiconductor equipment. Semiconductor, so there you go. All right, let's get to the ugliness here. Lululemon did not perform well. As I'm doing this, I am wearing a Lululemon shirt in support of the company. And maybe I'll grow my beard to support the team on this one, right? Isn't that what hockey fans do? Support their team, grow your beard. Look at this 5-year chart. And look at Lulu, 167.77, lowest in 5 years. I went back to see where, on a weekly basis, it closed lower. May 1st, you got to go back to May 1st, 2019 on the weekly close to get a lower price in 167.77. We are at a 6 1/3 year low, sitting at 13 times forward earnings. And when I say the forward, I'm talking about their lowered guidance. They lowered their EPS guidance by almost $2, or a little over $2. So, if you had a multiple of 15 times 2 is $30. That's what they shed. 13 times forward earnings. I don't think that their pain is done yet. So I do ask the question, are we looking at a contrarian play or a value trap? They had really good international growth. It's their U.S. sales that are hurting. So to me, that's sort of sounds like it's a contrarian play, because you can probably solve that. If it was dead sales everywhere, that's a bit of a problem. But international up 19%. I'm going to go through the earnings top 20 here in a second. I did create an earnings infographic for both Lululemon and Broadcom. So if you have the link to the Google Drive, you'll be able to download those. Let's deal with my position. I'll explain what I've done here. I was long 700 shares. I had sold 220 and 215 puts, so I was long 700 shares at an average price of 210.21. I had sold against that 11 200 calls for 10.50, and I was short 4 180 puts at 8.15. These will expire worthless. I'll get all of that premium over here because I don't think 200 is going to happen by next Friday, so I'm just going to let those expire. These will be put to me because I don't see it exceeding the 180 by that point. But maybe I get lucky. Maybe I get lucky and it does. But these will be put to me. If all of these are put to me, I'll have 1,100 shares at an average price of 185.76. We're 167.77. So you can see $18 down. Multiply that by 1,100. And it's a 4-letter word that starts with U. Ends with H. Ouch. So what I did was I went to the 150 Octobers and I sold 25 calls. I got 23 for selling the 25 calls. If I size this for 1,100, and how you do that is you take the 25, you multiply the premium, you divide by 11. Basically 52.27. From the 150 to the 185 is roughly about $25. So I only need half the premium to disappear, and I do think we're going to get some more weakness on Lululemon over the next few weeks. And as soon as half the premium has disappeared, I can close this without a loss and walk away. turn something ugly into something neutral. And if it hangs out above 150, the longer it hangs out there, I can actually turn that into a small profit. But I had to do something aggressive. With selling these, I am now slightly negative delta on the position, because these calls do not have 100 delta to them, right? So I am slightly negative delta on this one right now. So you could say that I do have the combined position with all the options and long position. I am net negative short Lululemon right now. It just wasn't good. Let's go through some of these numbers here. Their earnings, you would look at their EPS and you would say they did well, 310. The range, the guidance range, 286 to 288 was roughly the expectation. They did 310. However, 15 cents of that came from just accounting. It was stock-based compensation reversal that accounted for 15 cents, so it boosted their EPS. So if you take that out, that was 295 versus an expectation of, call it 287. Not such a big beat. Revenue missed. It didn't miss by much. So it wasn't really so much the earnings. You could forgive the earnings. You could forgive the small miss on revenue. Missed by 100 million, 2.53 billion. Street was expecting 2.54 billion. So that was a 7% year-over-year increase. 7%. So that's not bad. Year over year, there's growth there, but that growth is slowing down. Net income dropped to 370 million from 392, but keep in mind there is the reversal of the of share-based compensation in there. Gross margins decreased 1.1% to 58.5, which again for retail, that is not bad. 58.5 on gross margins. Operating margin fell 2.1, 210 basis points to 20.7. 240 million in annual profit impact from tariffs and the elimination of the de minimis exemption, which even if the tariffs can go away, that de minimis exemption still stays in place. That is overall, it's not that bad. 240 million in annual profit, but if you have a net income that's at 370 and you expect a 240 hit, oof, that hurts, right? Let's see what else we have here. Guidance. This is where it really killed. Lowered fiscal 2025 sales guidance to a range of 10.85 to 11 billion, which represents about a 3.5% growth rate. Market was, or their previous guidance was about a 6% growth rate. That's a big drop down. Reduced EPS outlook. This is the killer. EPS outlook, 1277 to 1297. Take the midpoint, you got 1287. Right, that's where I get the 13 times forward earnings based on this price. You just divide that price by 12.87. That was lowered from a range of 1458 to 1478, call it 1468. From 1468 to 1287. Almost a $2 drop. So you multiply that by the forward multiple it might have had, 15, there's your $30. That's a big hit, the EPS. American same-store sales declined, 4% down. With 7% growth, American same-store sales down 4%. International carried the day on this one. The CEO acknowledged the company's product cycle had run too long and become too predictable, particularly in lounge and social categories, missing opportunities to create new trends. And I've said this before. I said it with AT&T. I said it with Bell. All I want to know is that management recognizes it has a problem. That is the biggest step towards a solution. But if management doesn't even recognize it has a problem, there's nothing you can do but sell the company. So there's a head nod towards the problem. A recognition, hey, listen, our product lineup is a little stale, and we haven't been doing our job right there. Good. To regain U.S. momentum, Lululemon plans to increase new styles from 23% of its overall assortment to 35%. What else do we get? Strong international growth. International revenues year over year surged, led by strong performance in China. China, depending on what currency basis you're looking at, because it is consolidated, so it's 21% or 39% controlling for the US dollar. Still, that's pretty good. Whole bunch of price cuts came in on this as well. Bernstein down to 220 from 350. Needham 192 down from 238. Wells Fargo 160 down from 205. These are 1-year price targets. We're at 166.77. I think you see 150 before you see 200 on this one. I think it's gonna do as a sort of some bottoming out for a while. The market's gonna want to see results. I don't think hope. This is not a Tesla thing where you can say something and there's just simply hope. You know, a whisper of a glimmer of hope on the horizon and up it goes. This is going to be a show me stock. It's going to have to show the market, and you got 13 weeks before it can show the market anything. So over those 13 weeks, there's going to be a lot of people thinking, you know, it's yesterday's name. It's pretty much done. So I think it has some downside pressure to that. Speaking of whisper of a glimmer of a hope on the horizon, Tesla's European sales just crumbling, and its stock went straight up. Give Tesla's CEO a pay package of $1 trillion. Float that out there in the market. We're over 10 years up to $1 trillion, and the price went up. I don't know. I think if he walked into a school and shot a bunch of kids, I think the price of the stock would go up. What could make it go down? It doesn't respond to any news at all. That was a pretty dark comment, right? I take that back. Let's look at Broadcom. Completely different story on Broadcom. Up like 10%. Look at, I got its chart up here. This is a 5-year chart. Look at where it is. You know, in the last 5 years, this is July 2023. Just in the last 2 years, you just have this going on over here. Look at that. All-time high on Broadcom. They announced that they have a 4th customer for their XPU chips. An XPU chip is a chip that is designed for a particular application. This one here for AI specifically. GPUs are used because they're fantastic at this sort of thing, but they're not designed specifically for this particular type of thing. The XPUs are. 4th customer. And it wasn't disclosed through Broadcom. It was disclosed. This Financial Times said, according to insiders, it is OpenAI. They will begin shipping. It's a $10 billion order. They will begin shipping in 2026. This has to have some effect on NVIDIA. Let's have a look at what they've done. Earnings beat. If we look at the adjusted Q3 EPS, 169, beating consensus 165. Revenue 15.96 versus 15.83. Beat on EPS, beat on revenue. Revenue growth 22% year over year. Killer. Net income 4.14 billion, 85 cents per share. Strong cash generation, record 7 billion, up 47%. Major customer win here, secured $10 billion in orders for custom AI chips, XPUs, from a 4th customer, with analysts believing this customer is likely OpenAI. Let's look at their guidance. Where's their guidance? Here it is. Guidance and outlook. Guided Q4 revenue to approximately 17. This is just Q4 now, right? To 17.4 billion. Wall Street was expecting 17.02. And if they hit the 17.4, that's 24% year-over-year growth. Expects AI semiconductor revenue to reach 6.2 billion. That would be, it says here, 11 consecutive quarters of AI growth. Q4 gross margins will step down modestly on product mix, more XPUs and seasonal wireless, though adjusted EBITDA guidance remains strong at 67% of projected income. Chip sales rose 57%, driven mostly by AI accelerator networking demand. and then just a bunch of other little things. I will let you read the top 20 when it comes out. Analyst price targets. Lots of let's not read those. I'll let you read those. I think this continues. And what do we get this week? Another AI related stock, another open AI related stock. We get Oracle this week. Overall, I would be selling puts on Broadcom on any pullback, and I think I would be selling calls on LULU on any rally. We have two different stories here. And that is it for this week. The big day, CPI this week, if you're in any kind of duration, and especially ZQ. That is your big moment for ZQ this week is Thursday. And I will see you for the Q&A on Wednesday, and I'll see you next Sunday.